Hey there, everyone. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller. It's Tuesday, September 9th. We're coming to you just after 5 o'clock Eastern, 2 o'clock Pacific, in a wonderful, kind of classic fall Seattle day here in Redmond, Washington. Kind of a light drizzle. You don't really need a rain layer, but you have one anyways. Don't need an umbrella because you definitely don't carry an umbrella around these parts. But overall, kind of a classic, wonderful, not too hot, beautiful day. Market opening weaker, closing stronger, and I think the course of the trading day today pretty encouraging. Although in certain areas of the market, a little less so. And you're going to see mid caps and small caps had kind of a rough day of it. Not really clear leadership trends, and you're going to see that the top S&P sector, not a growth leadership sector, but one of the more defensive sectors. As a matter of fact, two of the top three sectors were on the defensive side. Apple's event earlier today, not looking great on the chart of Apple, but not horrible. You'll see what happened there. If you're an Apple shareholder waiting for a big upside move, as we talked about on the show yesterday, given the product announcements earlier today, I would say a muted reaction to all the things coming out today, which is a risk with one of these big product announcements. A lot of things to talk about, a lot of things to look at. And we'll get to the market recap as we do so. As a reminder, we're live streaming on Facebook, LinkedIn, YouTube, and X. I appreciate you guys tuning in live. Those that are doing so, you have the ability to ask questions all during the show. We'll keep an eye on that chat as we go through some market updates and some heat maps and some charts. We'll take a question or two at the end of the episode. Any of the questions we don't get to, we'll put them in the mailbag. We're planning an all mailbag episode on Friday of this week. We'd love to answer your question there. Also, as a reminder, if you're watching our YouTube channel and watching the video later after the live stream, thanks for doing so. And drop a comment or drop a question in the comments section. And we'd love to take your questions for a mailbag episode. So here's how things played out today. Let's look at the numbers. We'll look at the heat map. We'll look at the charts. We'll call it a great afternoon here on Chart This. So the S&P 500 up about 0.25%, closing around 65.12, we'll call it, and change. Nice acceleration going into the close. Right earlier in the day, we opened, pushed just above 6,500, basically pushed up to yesterday's high, traded down to go to yesterday's low, and then we accelerated to the upside. So if you ever wonder why on a platform like Stock Charts, why do they do a 2-day chart? Why don't they just do a 1-day chart and stretch it out? It's because this happens more often than you probably realize, where levels that were meaningful yesterday are still relevant for some reason in the days to come, right? Traders talk a lot about pivot points, about specific price levels. I often keep an eye on a number of key levels. Yesterday's close, which is a blue dashed line on my chart here, is always kind of an important pivot point, right? To just see if we're closing above or below yesterday's close. Yesterday's high and low often come into play, and we're seeing that on a day like today, particularly when there's not a ton of significant drivers to the upside or downside, and the markets are left kind of on their own to have the normal ebb and flow that happens as buyers and sellers are exchanging shares. This is where these things tend to happen. So powering above 65.05, going higher into the close, pretty encouraging here. Kind of a nice way to continue the week here on Tuesday, going into a lot of economic data over the next 48 hours, the next two sessions. Note that the VIX, no real change here. So even though the markets were going lower, the VIX is still in a very low volatility range, down about 15. Anything below 16, I would consider very low volatility. That just means markets saying not a lot of fear, not a lot of uncertainty, kind of a slow and steady uptrend phase is what the VIX is telling you right about now. We've been covering the rally in bonds, and we talked about that yesterday. Particularly had a chart of the TLT. We looked at the stock versus bond ratio. So if you missed that, make sure you go back and check that chart out, because I think those were important ones to just recognize or acknowledge the fact that the bond markets have been pretty strong here over the last couple of weeks. Pulling back a bit today, and the TLT is giving back some of those recent gains, down about 0.6%. We can see that rates generally moved higher today. So from the 5-year to the 30-year point, drifting higher. And this is after yields have been coming down pretty aggressively. So sort of a counter trend move to the upside. Dollar up slightly, about 0.4% for the UUP. That's a bullish dollar ETF. Looking at the commodity space, commodities opened higher and traded lower through the course of the day. Enough for crude oil and natural gas prices to be higher. Copper prices higher. Precious metals, which have been some of the strength in the commodity space, pulling back a bit. The GLD was down about 0.25%. This is after making new all-time highs again here in the month of September. Same for silver, down about 0.9%. So just slight pullbacks after significant moves. So with stocks kind of rallying up, with bonds pulling back after their recent rally, and with commodities, particularly precious metals, pulling back, it's a bit of a mean reversion day all around. Bitcoin currently trading around 111,000, that is 550, and this is down from over 113,000, which is where we were kind of overnight Eastern time. This was yesterday as we're doing the show. We're kind of chopping around that 112,000 level. It actually had a nice springboard move up to just over 113,000, down to around 111, and then bouncing higher to where we're at presently. So a bit of a sell-off going into the equity session. And then as equities rallied, cryptocurrencies generally rallying as well. Ethereum holding steady just about 4,300. This is coming down from 4,380 earlier today. Looking at the 11 S&P sectors, more up than down, right? So you've got 7 sectors up, 4 sectors down. Utilities at the top of the list. Utilities, technically a defensive sector. It's been kind of a growthy sector generally in 2025 with all the energy requirements of AI and crypto mining and all those sorts of things. So utility kind of providing the fuel, as it were, for all of that great technological development and advancement. Utilities up 0.7% today. Communication services and healthcare both up about 0.5% to round out the top 3. On the downside, materials down 1.6%. Industrials down 0.2%. Consumer discretionary and REITs basically flat for the day. Breadth wasn't great today. It wasn't horrible, but it wasn't great. It depends on where you look. If you look at the New York Composite Index, actually quite bad. 61% down to 36% up. It's about a 2-to-1 ratio of decliners versus advancers. Mid caps and small caps much worse, about a 3-to-1 ratio of stocks down versus up. I don't think I mentioned that on the front page, but the mid cap and small cap indexes were both down today. So while the S&P generally trended higher and the tech-heavy NASDAQ 100 finished stronger, mid caps and small caps weaker on weaker breadth. So a bit of a divergence between those two here today. Looking at the Magnificent Seven leading growth names, we can see Alphabet, continue to push higher after a gap and run pattern on the daily chart, up another 2.4% today. Meta encouraging that it's up another 1.8% today, because Meta is one of those that had been pulling back to clear support. And the question, I think, going into September, does it hold that support after pulling back? And for now, holding it just fine. Netflix and Nvidia both up about 1.5% today. Only 2 names in this basket that were down. Broadcom down 2.6%. Broadcom, had the gap higher on earnings. Yesterday was sort of an inside day, and then today down again. We'll look at that chart here in a moment. Apple, I did grab that chart already, down about 1.5%. I mean, the problem there is they just had a monster product announcement, right? I mean, new iPhones, new AirPods, new iOS, new all these things, and the stock is down. That's not encouraging if you're an Apple shareholder. I'm not, but I certainly have plenty of exposure to Apple through different ETFs that I own for sure. Looking at Broadcom, I mean, Broadcom's not a bad chart, obviously, because we're coming off of a new all-time high, 2 sessions ago. That was Friday of last week. Here's the problem, though. This is the big gap higher on earnings, and instead of trading higher after that gap, think about what this chart is telling you, right? Here's the earnings day where we had this huge gap up to the open around 356. We closed around 335. The next day, kind of sideways, a bit of a shooting star candle. Day 3, which was today, higher open, lower close. So, while this 3-day pattern is not a particular candle pattern that has a name that I would tell you this is a dark cloud bullet pattern or something, I'm making that up. It's not. But it's not great, because what happened is, since that gap higher on earnings, that's been it. We have not even touched that level again over 3 trading sessions. So the gap higher was sort of it. And now there's just been a lot more distribution than accumulation, right? Investors are selling on that short-term strength as opposed to taking this as a great opportunity to buy even more Broadcom up in the 340, 350 range. Investors are thrilled to cash out after making some gain after buying it earlier in the uptrend. And that's kind of what a bull market in an exhaustion phase kind of looks like. So for now, it's certainly appearing to be a bit of an exhaustion gap, right? There's different ways you can describe price gaps based on where they happen in the trend. And when you have a big uptrend and then a gap higher, and then you just completely stall out, which is what's happening here. Usually you think of that as an exhaustion gap, meaning that's kind of the end of the move, right? That's that last gasp. And instead of a bunch of buyers coming in, there's an absence of buyers. And eventually the selling pressure kind of takes control. And when people realize other people aren't buying it, then they start to get nervous and sell. And that's what usually causes a fill of the gap and sort of a downside follow through. So kind of a lackluster follow through after a decent earnings win last week. And again, that's a bit discouraging if you're looking for Broadcom to sort of continue the uptrend. Now, the good news is it hasn't broken down. The good news is the 21-day EMA, which I'm actually not showing you here, but I can add that. Here we go. I usually do the 21-day EMA. That's here. So kind of down around the 309 level. So 27 points below today's close. So plenty of room to have a bit of a pullback and still be within a consistent uptrend. The last couple of pullbacks have stalled out at the 50-day moving average, which is currently around 294. So it's not a bad chart. It's just a great chart would have continued higher by now is I guess the way I would think about Broadcom. All right. I think that's it for the Mag 7 names. We're going to come back to some of these. Let's continue on and go to the heat map. As a reminder, I do see some comments and questions coming in on these various platforms: Facebook, LinkedIn, YouTube, and X. Appreciate the questions. I'll grab one or two at the end of the episode. Again, if you're watching the replay, just put a comment below with your question. We'll hope to answer it in our mailbag episode. Looking at the heat map here, and again, the way I use the heat map, if you're new to the show and new to my work, heat maps for me, visualizations like this, I think are fantastic. I love things that allow you to look kind of macro to micro, look big picture to small picture, all in one visualization. That's what this allows you to do. And by starting at the high level, asking questions like, what did the day look like? Where am I generally seeing strength and weakness, and in what types of stocks? Then being able to drill in and look in a little more detail about specific sectors and what individual names may have been outliers, right? What stocks are down in a sector that was up today? That's where you can really start to drill in. And a platform like StockCharts and other platforms that have heat maps usually allow you to drill in. So here you double click to get to the chart and really understand things a little bit further. But I'm a huge fan of this type of visualization, which is one of the reasons why I feature it on the show every day. So general impressions here. So I'm immediately drawn to areas of green to start off with. Right in the middle of the heat map, we have Alphabet, Meta, and Netflix, the three big communication services names. Now, yesterday, if you watched, it was a bit different because it was more about the movement in the telecoms and the lack of upside in some of those names. Today, we're getting a nice upside follow through. This is why communication services ended up being one of the top sectors today. So Alphabet, pretty extended, right? It's sort of doing what you would hope Broadcom did or would have done, which was a gap higher on earnings, and it just continues. Alphabet had that news last week related to the Chrome browser, really upside, injection of bullishness, and that's just continued, right? Additional buying all the way up here. Netflix a little more nuanced right now. I think what's encouraging about the chart of Netflix is that we're just breaking up to a new swing high, right? So if you're avoiding a Netflix in this kind of move, right? So here's August and this is July. So it peaked around the end of June. July was kind of a bath of a month, right? I mean, just sort of a consistent downtrend, broke below moving average support, kind of in no man's land between the 50 and 200 day. Then we have a bounce higher, and then we sort of trade sideways for a little while. Just in the last week, you get the sense that Netflix is now making a higher high after making a higher low, right? So we have a higher low around 1,200. We now have a higher high pushing above 1,250. That's pretty good. And what that tells you is that this is now resuming the primary uptrend with a retest of the previous highs as a reasonable expectation. Look how the RSI today is pushing above 60. So I'm a big fan of what you call the range rules when you're using an indicator like RSI, right? In a bullish phase, the whole range of the RSI drifts higher. In a bearish phase, the whole range drifts lower. So noting when we can break out with the RSI pushing above 60, that kind of serves to confirm that we're in a bullish phase for Netflix. So the break to a new swing high on stronger momentum, pretty encouraging. And I think, if you look back to this sort of move, right? Kind of similar to where we're at right now. We had a new all-time high. We undercut the 50-day moving average, kind of retested the 50-day. Here we actually made a lower low. But then look here where we break to a new swing high. This is above 1,000, and the RSI pushes just above 60 as that happens. That often leads to another further, appreciation. So I like the breakout in Netflix. That's a good one. I think I like that. I like that upswing. So first thing on the heat map would be the strength in some of those communication services names, kind of the new area, new part of that sector, not the old telecoms like AT&T and Verizon. Second group of stocks that I would note would be in technology, Palantir, AMD, but I think the one I'm really excited about is Micron making a new all-time high today. Amphenol, APH making a new 52-week high as well. The entire technology sector did not do particularly well, and we'll talk about Apple again here in a moment. Not a bad chart. I mean, still a good chart, just not breaking out the way you'd probably want, given a big news event and all the hype going into today. So kind of mixed, but I'm drawn to some of the names that are improving, particularly Micron in the semiconductor space. Third would be financials, right? You've got Goldman Sachs, Morgan Stanley, both making new highs today. Some of these not quite doing so, but still in primary uptrends. There's some divergences to think about. And I did grab the chart of JP Morgan to sort of show what concerns me about that chart. But I would say overall encouraging that there's a lot of green in the financial sector. Also healthcare. We talked about the XLV yesterday. UNH up over 8% today, breaking above our line in the sand that we described on yesterday's show. So that's all the goodness. What about the not so goodness? Consumer discretionary with a lot of red, particularly in home builders. Home builders have been en fuego recently, pulling back today. And this isn't, the trends are still in good shape on charts like PHM and LEN and DHI. They're pulling back today, so just something to be aware of. I don't think that's a end of the world down day, but certainly a counter trend move within a primary uptrend. A lot of red in industrials. Not a lot of charts looking good in industrials today in terms of today's movement. Some of those trends are still in decent shape, but I'm seeing a lot of red in a lot of industrial stocks, and the materials as well, right? With some of these names rotating lower. Materials ended up being, I think, the worst sector today, as we noted. Freeport McMoran is an example of a chart that would, that's sort of a lack of follow through, right? This is a pattern that we observed in a lot of the Magnificent Seven stocks. We have kind of that double top pattern, right? Microsoft is one that pops in my head. We have the big rally to a high, you pull back, you have another high and retested. And the question is, do we get above? Do we have enough momentum to get above that level? For now, FCX not quite doing so. I think it's a really compelling chart if and when we get above that previous high. 47 was the closing high back here in July, and that's the peak that we hit last Friday. So worth noting, FCX for now kind of stalling out in an attempt to make new highs. That's why I often think about those previous highs as a trigger, right? Breaking above that high really validates the uptrend and suggests that there's further upside maybe to be had. I think that's it for the heat map. Let's continue on and look at some charts. The show is called Chart This, so the more charts, the better, I would argue. Looking at the chart of the S&P 500, again, if you think of last Friday's higher open and lower close, Monday and Tuesday of this week, kind of inside days, right? Fitting within the range of that big volatile day on Friday. So the volatility in terms of the VIX remaining relatively low. So far this week, Monday and Tuesday, kind of quiet days in terms of a directional move in the overall benchmarks. We're holding 6,500. We closed above there today for the first time. So on a closing basis, this is a new all-time closing high for the S&P 500. But every one of these that comes on weaker momentum just doesn't make me feel great. I was thinking about this. I was, we're relaunching the Market Misbehavior podcast after taking much of the month of August off. And doing an interview actually later today for the podcast that we'll release here in a day or two. And I was reviewing my conversation with Adam Koch, who's a financial advisor based in the Columbus area, who've known for a number of years. He's a fellow CMT. And we were talking about, he compared big bearish, macro indicators like a tornado siren, which if you live in the Midwest or particularly in Columbus, Ohio, when I went to Ohio State, they have these big tornado sirens right next to campus because we looked at an apartment the one year. There's a total sidetrack here. We looked at an apartment when we were in college, my roommate and I, and we looked at it, we loved it, and we walked out, and it was Wednesday at noon, and this tornado siren was right outside the door, and it went off. We're like, "Yeah, this is not the place." But they have big tornado sirens because obviously, when conditions are right, when there's a warning, when they're concerned that there's a high likelihood that a tornado could be around where you're at, tornado sirens fire off. And so things like the bearish momentum divergence, you think of it like a tornado siren. Is it a guarantee that a tornado is going to tear through your neighborhood and have a ton of destruction to your portfolio or to your house, your financial house? No, there's no guarantee. But when I hear the tornado siren, do I want to go down in the basement? I do, right? I mean, even though I'm not sure that's going to happen, I've heard enough to think, okay, this is sounding like and feeling like conditions that often lead to something really bad. So let's be safe and get a little more defensive. That's what I think of these relative strength index, the RSI divergences, what I call a bearish momentum divergence. And again, thanks, Adam, for a fantastic analogy. I love that one. I'd not heard that before. But that's kind of where I'm thinking. It feels like the tornado sirens are firing here in early September with things like breadth divergences and momentum divergences. Again, no guarantee that the market can't just go fine and ends up not being a tornado. And boy, we got all riled up for nothing. But I'd much rather kind of get in the basement and get the radio and get the lamp and the flashlight and just be safe. And that's kind of what I'm feeling right about now. The way that is negated, by the way, is you move higher on stronger momentum, and that's what we would need to see here in the next week or two. The divergences are elsewhere, and here we're showing a couple divergences in breadth. That's a divergence according to momentum on the previous chart, price versus the RSI. Here we're looking at a chart, which I just call the chart. This is a sort of a checklist looking at 5 key metrics that I track to, just sort of determine the overall conditions for equities, right? When these are all bullish, I feel pretty confident that the market's in an established uptrend. I don't have much to worry about. When they're all bearish, it's pretty clear we're in a downtrend phase. When they're mixed, then I realize that the evidence is not clear cut, and that is where we're at right now. So what is clearly bullish? Out of these 5 things, and just briefly from the top, we have the trend in the S&P 500, the advanced decline line for the New York Stock Exchange, percent of stocks above their 50-day moving average, the bullish percent index, which is a breadth indicator based on point and figure charts, and then offense versus defense, looking at consumer discretionary versus consumer staples. Which of these are pretty bullish? So I would say the trend in the S&P clearly, nothing but good, right? Higher highs and higher lows. We're making new all-time highs again here in September. That's bullish. That's not bearish. Offense over defense, very clearly favoring offense, right? Consumer discretionary driven, in a lot of ways by Amazon, Tesla, Home Depot kind of charts. But this is the equal weighted ratio, which means it's not just about Amazon and Tesla. This is the, kind of average consumer discretionary versus average consumer staples. It's been clearly trending higher, certainly in the month of August and continuing so far in September. So the trend is positive and offense is outperforming defense. What's kind of neutral? I would say the advanced decline line, right? So these new highs in August never confirmed by the advanced decline line. The most recent new all-time high we made was in mid-July. From there, all through August and now early September, we still haven't eclipsed that peak. So the market's going higher on weaker or on with no confirmation, I guess, and non-confirmation from the advanced decline line. So I would consider that neutral, right? What's bearish or what's not bullish would be the divergence that I'm seeing in percent of stocks above their 50-day moving average. So every new high since the end of June has seen less stocks regain their 50-day moving average. And then the bullish percent index, which is still down around 61%. So that means about almost 40% of the S&P 500 members are currently sitting in a bearish point and figure profile. So even though the S&P is making new highs, and even though the breadth or the offense is outperforming defense, there are a lot of stocks that are still in a downtrend according to their point and figure chart. So, you have a 2 bullish, 1 neutral, and 2 bearish. I mean, it's literally kind of a, 6 in one, half a dozen in the other. There's no real clear, I would say, signal on my kind of cheat sheet looking at these 5 main market indicators. Having said that, I sign off every episode of this chart with, it's always a good time to own good charts. Let's see if we can uncover some of those, or maybe identify some that are not necessarily good charts. So here's the good news for Apple. It's still in an uptrend, right? We're coming off of a new swing high on Friday, pushing above 240. The previous highs were back in December, just around 260. So we got another 20 points to get up there, 25 points with today's drop. The problem on this chart is how the chart relates to the news that we had earlier today, right? So when people ask me about technical analysis and charts and say, well, how do charts matter when this is all about like Apple's product line or Apple's revenue stream or Apple's, revenue from China or reinvestment in the US or whatever? And I will tell you, the charts are incredibly meaningful because they tell you how investors are interpreting and reacting to, and how their expectations are changing relative to all of those things that are coming out, right? A bunch of people hear the same things you do and read the same things and analyze the company and then make a buy or sell decision. So if investors are all excited after the product line is announced and they're really optimistic based on everyone going and buying another iPhone and all these other things that they talked about, then Apple's price should be a lot stronger than it was today. Today, the stock sold off despite the fact that all of those announcements were going on. So kind of a muted reaction, kind of a less than ideal reaction. If you're looking for this to be a positive catalyst, we didn't get it. So now we're left with Apple pulling back this week with a bearish momentum divergence, higher highs in price, weaker momentum. So this sort of, I think, reinforces the fact that the Magnificent Seven as a basket of stocks are really not similar at the moment. There are some like Alphabet that look remarkably good. There are some like Nvidia that have been rotating lower. There's some like Apple that are kind of in the middle, and I think may potentially changing character here this week. But I think the lack of upside is a concern here. So again, if you have a position in Apple, I don't personally, but if I did, how would I sort of think about it? Well, it depends on your time frame, of course, but remember from a technical perspective, it always helps to look at where we're at and look to the left. So 225, kind of a key support level. That was the most recent swing low, third week in August, and that was the bounce that we saw up to 240. So I think as long as 225 would hold, that's kind of a great short-term support level. The 200-day moving average a little bit below there, around 221. So kind of that 221 to 225 range. That's kind of where I would maybe expect a tactical pullback to sort of find support. If that wouldn't happen, that's sort of the get out of Dodge type of pattern for me. I think Apple below 220 is all of a sudden a very concerning chart, and I would actively be looking elsewhere. So for now, coming off of a new swing high, but the lack of follow through potential issue. Micron pushing higher, and I can see on the chart exactly what someone mentioned in the chat here. I think incorrectly mentioned earlier, there's a new all-time high for Micron. My apologies. New 52-week high, yes. New all-time high, no. You can see there were highs earlier in 2024. Here, summer of 24, we're up here above 150 on an adjusted basis. Thanks for pointing that out. My bad. But again, the move to a new swing high is encouraging. And I think what's good about the chart of Micron is the fact that we're pushing above 130. So look at what happens here this week. We gap higher on Friday. We continue higher, right? So think of the chart of what was that? A couple charts we just looked at. Now I've shown too many charts and I forget. It was one of these where we gap higher and then stall out, right? And sort of Broadcom was the name, right? We gap higher and then we kind of don't go any further. Here we gap higher and then continue to drift higher, right? So gap and run is what I call that pattern, right? We have an initial bounce higher and then you just kind of continue further, because what this shows you is that additional buyers are coming in. And we were optimistic, a Thursday into Friday, and then there's additional buyers willing to pay more and more for the stock, pushing it above previous resistance. And that 130 level was the peak in June and the peak in August. So I think that's a great actionable breakout. And the RSI is improving, right? We had a bit of a divergence here with a weaker momentum on this retest of 130, but now we're breaking out on stronger momentum. I think that's a nice upside rotation for Micron and a good breakout there. Speaking of good breakouts, United Healthcare, we talked about this yesterday, talked about that 320 level, right? Encouraging that the stock had gotten up to resistance, but we need to not just trade to resistance, but through resistance. And UNH following through today. I mean, healthcare, we've mentioned this a number of times here recently about, interesting charts kind of emerging in that sector that has been so underappreciated and underperforming for so long. So the breakout above 320, I think, is a really good one. The way that I tend to think of a chart like this, kind of that's your, you buy on a breakout and then you use that breakout level as an initial stop. That's kind of your initial line in the sand. Anything above there is good. Anything below there, maybe we revisit and think about other levels of risk. But I think that upside follow through, I wanted to make sure that we saw that because we just talked about that on yesterday's show. Highlighted on the heat map, the number of financial stocks trading higher. We can see JP Morgan making a new high above 300, actually just briefly above 305 earlier in September, pulling back to an ascending 50-day moving average. So, good chart. What concerns me on a chart like this is the momentum, right? So similar to the S&P, every new high since June has been marked by a weaker RSI. Compare that to something like Morgan Stanley, which is actually pushing to new highs, potentially breaking out on stronger momentum here. So I like this sector. I mean, the financial sector has been a great area of emerging strength. My most recent podcast interview with Larry Tentarelli, we talked specifically about banks, financial stocks, talked about regional banks in particular. He highlighted along with some others. And I would say some of these, still in divergence mode. I think a stronger move on stronger momentum would really unlock a very bullish technical profile for charts like Morgan Stanley and JP Morgan. All right. Shall we take some questions here? I had a couple of these. I do see a question, 3P Investor. I've had some questions about the Hindenburg omen. And I don't dust off my TA book. At some point I will make time to write another book, and I've thought about it and discussed it. Man, the time and energy commitment is not something I've been ready to do, but at some point I will hopefully get to that, and I will certainly keep you informed when that happens. But for now, the Hindenburg omen, I have gotten some questions for that, and I appreciate that some of you are realizing this is kind of the time when you would normally see it. As a reminder, I'll show you, it hasn't fired yet, and I'll show you what we would need to see. This is the Hindenburg omen. If you follow my market misbehavior live chart list, you can find that at marketmisbehavior.com/charts. It'll get you to live versions that Stock Charts very thankfully hosts for all of your benefit. It's free to access. If you want to save them to your own login, you need a paid Stock Charts login, but you can see the charts as I've notated them through that link, marketmisbehavior.com/charts. Basically, this is the chart. Here's the price of the S&P. It's going back a couple years on a daily basis. It's the New York Composite Index, particularly the rate of change on the NYSE Composite Index, because that's one of the items is the trend in the New York Stock Exchange has to be positive. The way that is built into this model is the 50-day rate of change needs to be above zero. That's the black line. As long as that's above the zero line over here, we're good. So that's the one that is correctly showing. Number two, we need at least 2.5% of the New York Stock Exchange listings to make a new 52-week high, and at least 2.5% to make a new 52-week low on the same session. This has not happened in quite some time. We've had plenty of new 52-week highs over the last month, but very few new 52-week lows. This is something that the creator of the indicator found, Jim Mieka, found was really common at market tops. So you'd have this kind of indecision where there would be things breaking out and breaking down at the same time. We haven't really had that recently, so that's one that has not been firing. And then the McClellan oscillator needs to go below zero, and it actually is just back above zero here in the month of September. So only one of the three criteria for the Hindenburg omen are firing. On top of all this, we would need to have two separate signals within one trading month. I've highlighted in purple the last two times that's actually happened. The last time we had a valid confirmed Hindenburg omen signal was at the end of 2024. And looking back, I am super thankful for that because that told me to be super skeptical of uptrends in the first quarter, which ended up, leading into a major low in April. Before that, it was the end of 2021. Going into January of 2022, we had a valid Hindenburg omen signal almost, pretty much leading right into that major peak and then the sell-off that we had into the October 22 low. So this is something that does not have signal very often, every couple of years at best. We have not had a signal since December of 2024. That's what we would need to see. It's not there yet. This is one of the charts that I briefly review regularly just to see when the conditions are getting close. I'll let you know if we do get close to another one of those signals that were there. Not there yet though. So don't worry too much about that one. One more question here. Has some comments about Oracle. Saw a couple of these. Oh, here we go. Yeah, Bull Bear Jeff, you're dropping all the Oracle comments. Here we go. There's one of these. Bull Bear Jeff, as always, thanks for watching, my friend, and thanks for throwing questions in. As always, I appreciate it. Here's the chart of Oracle, and your comment was, what's up with Oracle? Could it be an exhaustion gap? Yeah, right. Interesting. So Oracle is coming up on earnings here, and so not a lot of earnings this week, and so I really didn't spend much time mentioning stocks like Oracle. Oracle is one of the few actually reporting earnings. We can see what's happening in the after hours. Yo, okay, that's why we're asking about it. It's up big time, right? Up 27%. That's a decent move to the upside. Oh, yeah, significant, right? So the other thing I do is on an intraday chart, we can make it a shorter chart and we can show the extended hours. So that's Oracle today, and then this is the big spike higher after the close, and then just drifting higher going into the release here. So, what is this? So, what's interesting is, and what's so fascinating about this chart is going into today's earnings, right? I often think about the patterns going into an earnings release. You call this a bull flag pattern, right? So a bull flag pattern is where you draw, one of the trend lines. I like to copy it and make a parallel line pretty close. I mean, it's probably more like that, but, pretty close. You can see these, there's a big uptrend and then a parallel channel, lower highs, lower lows. This becomes a really bullish chart if and when we break above that bull flag pattern. So, I would argue going into today's release, not really confirmed yet. Tomorrow certainly seems like it will be confirmed with the big gap higher. Yeah, and I think to your point, what you're saying is watch the watch a potential exhaustion gap tomorrow. That's true, right? So once you have this huge gap higher, the question is, are people willing to come in and pay more for Oracle after it's been bid up 20-25% overnight? That's going to be the real question like this. It does feel very, very late 90s for this sort of move to happen. It's not been that long since we've had these sorts of moves with Palantir and others, right? With these big gaps that we continue to run. But a big gap higher that starts getting sold aggressively, that could be an interesting macro tell. Is if you have a stock like Oracle, obviously with a great earnings release. I've not reviewed that yet in any detail. I'll try to make a point of doing so. But you have stocks like this gapping higher and then being sold after that gap. That's where I start to get concerned about the follow through on some of these names that have done so well with earnings. That'll do it for today's episode. Thank you guys so much for some interesting questions. We didn't get to all of them. We'll put the remainder into our mailbag. We're doing an all mailbag episode on Friday of this week. In the meantime, we'll be watching inflation data coming out tomorrow and Thursday. A couple more earnings releases. Other than that, it's going to be inflation and expectations for the Fed going into the Fed meeting later in September. In the meantime, have a fantastic evening. From Redmond, Washington, I'm Dave Keller reminding you, it's always a good time to own good charts. Have a good night, folks.